All right. Good morning, everybody. So, kind of a quiet morning when you think about what's on the docket. It wasn't so quiet last night when Bank of Japan threw some hand grenades into the FX market, but yeah, things are changing over there. Kind of a changing of the guard, so to speak, is changing their approach to kind of this financial experiment that they've been working on. Well, I think it's about a decade now. So big change compared to where they had been. It's going to be interesting in 2023 if they do pivot away from their stance that they've been on for such a long time, what we're going to see out of it. There's a typo. Maybe they'll increase their interest rates in 2019. I think we're a little bit beyond that. All right, so nothing really big on the docket today other than more housing. And I know I shouldn't be so, glib about the way I say that. I don't expect this data to be big enough to be impactful today after, with everything else. And we do have a European central banker speaking today as well. But that's it. Kind of a really light docket. As you can see, we have an additional auction at 11 o'clock. And when we're done with that, we're done. We'll have the rest of the day to do whatever we want. Unless things get a little rowdy, we should have a pretty good afternoon for a 0 day. As we could tell, the volume is looking a little better than yesterday when we were sitting at around 75. We're sitting way beyond that today at 125. We're within the normalcy range, which is kind of what we wanted to see with that thing, so we turn it off. We still have an MDP, although we're getting really close to it. We have not hit that daily pivot yet. We did have an inside day breakout in the overnight hours due to the Bank of Japan, but it basically has reset the gap. I know you don't necessarily believe that there is a gap, but when you get a really quick, sharp move like this, and it dumps really far down, we consider that a gap. It creates a liquidity vacuum in here that needs to be filled. And what you'll find is most of the time, price will work its way back up to where it was before it dumped. And then if it wants to stay bearish or bullish or whatever, right? And We see examples of that all the time. Go back and look at CPI last week or PPI the week before that. You'll see two really clear examples where we did exactly the same thing. The trouble is nothing always happens all the time. So, every time you see that, it's not like you can just try to go in the other direction immediately. Still, it did work out and get its job done. The thing is, once we do get it reset, then what? And that's kind of what we need to have an answer for today. Are we going to continue this bearish move that we had been getting, or are we finally done with that and going to get something else? Yesterday afternoon, we kept asking the question, was it going to rally up or was it going to continue to go lower? And we were just sitting in this sideways market structure like that right there. And the answer was there wasn't anything out there to see it rally back up, right? Like, what's the catalyst? What's the catch? What's going to change, the fund and the firms out there change their mind and get them to start buying? And the answer was nothing. There just really wasn't anything. So we ended up selling off a little bit more. We're still looking for that answer again today. And as we just went through on Finance Juice, there's really not a lot out there today that would give us any encouragement or an idea that this market's going to turn around and start going in the other direction. We have a 21-day ADR of almost 2%. It's 1.97. So from our current location, and we went to the ADR half already last night, 38.05. But from our current location, we could go to ADR half at 38.05 and then finish the move at 37.67. Or we could make a run in the other direction, 38.80, break through that 39.18. Along the way, 38.99, you might as well call it 3,900, is the high of yesterday. It's the Globex high. At 38.27, it's the low of yesterday. And the cash open matches our ADR half at 38.80. So we have a lot of pivot points to focus on. We have a lot of structure there, to aim for. All right, when we're at the top, we expect to go to the bottom. And when we're at the bottom, we expect to go to the top. We're at the bottom, but we were at the bottom yesterday. And we were at the bottom Friday. We just keep making a new bottom. Any move to the upside right now is going to have to get through the 38.80 area, which is, it's not a massive level of volume, but there is some volume structure there. And then 39.33, 39.30 is the cog line, but it's also the point of control. If we can get through that point of control, things really shallow out, right? Especially if we get, say, around 4,000, would be pretty good to go at that point, right? But we got to get through that point of control and all that resistance around that 39, call it anywhere from 39.50 up to 4,000. And again, we're still looking for any reason to believe that funds and firms and investors and, big institutions are buying this late in the year for any reason whatsoever, right? Why would they? The VPOC is gone, so we can take that one off of the books. We do have another one underneath at 37.88. It's been there for quite a while. If we make a move to the downside today below our own low, then that 37.88 is very likely going to become a pivot point that we focus on. The selling has been very controlled, very organized and clean. This is not capitulation movement. So kind of keep that in mind through all of this, right? There's different ways to approach how we see a market behaving and what the market is doing. Yeah, we're going down, but it's very organized. It's not like somebody yelling fire in a crowded theater kind of panic. This is more of, you know, those spoof plays that you see on when the Titanic was going down and people were still sitting around listening to music and drinking champagne while they were waiting for their boats to get put into the water. Bad analogy? If we follow the swings from the high to low, back through the high, we have every expectation of this swing low at least matching the previous low and or eventually breaking that low and giving us new lows. It's often easier to see if you're on a higher time frame, say like a weekly. That way these minor highs don't get you confused with the swing highs and the swing lows. But we are on track. Everything is doing exactly what it's supposed to be doing. The rising wedge breakout to the downside has unfolded textbook, just like it should. Looking at how far away from the 10-week moving average we are, we're exactly where we were yesterday, going into the close, near 2% away from the 10-week. That's not bad at all, since the average oversold. I hate the phrase, but we'll use it here. It has been around 4%, and we're not even below 2%. Step in a little closer, put it on the daily, and we're beyond 2% at this point. And the reversal is between 3 and 4, certainly beyond 3, right? So we'd have to see another 0.8% before we would even begin to consider that we have moved too far, too fast to the downside. So anybody thinking, oh, this is a great time to buy some calls just because we fell really far yesterday. I mean, you know, it's your money. But trying to take the other side just because we've fallen a long way in one direction isn't necessarily a good idea. Like, you kind of want something a little bit more than that. I do anyways. So there's that rising wedge we were talking about. Rising wedges break to the downside. It looks a little better on the SPX, where we actually had a Busby and then a solid breakdown. One question we want to ask is, where are we going? What's the destination? And when it comes to technical analysis, we can actually measure that off. So from the breakout point, just below or just around 3,700 would be the measured move breakout to the downside. We measured the widest part of the wedge, and then we copy and paste that over to where we broke out. Now, it's not perfect. You can see how I missed a little bit of the wick right? We could extend it a little more, but at the end of the day, it's not about to the penny moves anyways, right? It's very likely going to overshoot when it gets there. So, trying to trade it to a penny is not a really good idea. One thing I'm thinking about is putting some butterflies on around 3,700. In the SPX, you're not going to be able to make a butterfly less than 5 pennies because it's the SPX. It doesn't have penny increment options, but it's 5 pennies. Come on, man. You can't get a coffee at McDonald's for $5 anymore. So, yeah, throw a couple of them around 37. If you can get filled, maybe throw some at 36, 35. It's five pennies, How far out? I don't know. Look how far we've moved in 4 days. We've moved almost 200 points. So it's in 5 days, in 1 week. So what we're looking at here is the weekly expected move, the wide version. It's a 2 standard deviation as opposed to the weekly expected move that is a 1 standard deviation. So either way you wanted to do it, that's the expected move for the week. And this tool isn't as accurate as drawing it yourself, but if we, stay consistent using the tool, we're not even getting down to the edge of the weekly expected move yet. So we haven't fallen too far. Again, another argument against just blindly buying calls just because. Oh, well, we've moved so far in the last few days. Surely we got to go in the other direction now. No, we don't. We probably will, but kind of want to start to see it turn around and begin to move back up in the other direction first. If you want to hand draw the lines and you didn't get the lines on Friday, you can use Think Back, which is different from On Demand. On Demand is trash. It's worthless. But Think Back allows you to set the date and see the end of day data. And we closed at 38.52 on the 16th. That's the right day, isn't it? Yep, Friday the 16th. And on the close on that day, we're able to look forward a week to the 23rd, and we can see that the expected move was 87.80, 87.75. Split hairs. So you would take that 87 and add it to the 38.52, and that would be your top side expected move, and then subtract it from that same number, and that would be your downside expected move. What you'll find in low volatility conditions is your lines will match really close to these lines. But in high volatility conditions, these lines don't come close to what the real expected move is. And the main reason for that is that these lines cannot see this data in the options chain. It can't reach that. Mobius did a really good job of approximating this data, but at the end of the day, it can't read this. This is a significant gap that still needs to be filled. 3750 is the downside target. I don't necessarily think we have to get there today. It's the idea that we're very likely going to get there before we do anything else. So could we rally today? Yeah, I mean, we could. But I really got a feeling that 3750 is going to get resolved first before this market begins to think about anything else. Seeing a lot of talk about Santa Claus rallies. That happens after Christmas and into the new year. So it's not as we get up to Christmas, it actually is on the other side. I didn't make it up. I'm not the one that coined Santa Claus rally. I'm certainly not the one that makes the rules and the conditions for it. All you have to do is go to Google and type in Santa Claus rally stock market, and it'll start laying out all of the conditions and the criteria and the time frame and the history and all of the data that somebody who spent a lot of time and effort has already collected. No reason to reinvent the wheel. Stand on the shoulder of giants is what I usually say. Natural gas is still down. China names are down now as well, including emerging market, although that's not down enough yet to hit our benchmark. The dollar is down as a part of what we saw last night with the Bank of Japan. And the 20-year bonds are down as well. So we got stocks down, bonds down, dollar down. It's going to be a strange morning. With US dollar Japan making such an exaggerated move to the downside, it's down now more than 3%. We have every expectation that gold will be up. It's the way it goes. US dollar Japan goes to the downside, gold goes to the upside. It's very much like a teeter-totter. And it's what we're seeing this morning. Bitcoin is also up this morning, kind of leading the pack. And when we think about Bitcoin, kind of think of the names that are in the Bitcoin space. MSTR, Mara. But oddly enough, those chip names, NVIDIA, Taiwan Semiconductors, AMD, they're all still down this morning. So the chip names are not appreciating this move in crypto. Looks like pot stocks are up as well this morning. So we've got gold, Bitcoin, pot stocks, silver, obviously. It kind of goes hand in hand. Hey, you goofy little. My cat finds anything that's not a toy and then decides, ooh, I'm going to make that a toy. Arrgh. All right, so net gas this morning is down to 1730, 1735, something like that. So another significant gap down $17 is a little bit of a benchmark. Kind of need to hold that level. See if we're going to keep it or not. We very well may see an overshoot in this. Kind of just clean it up here a little bit. From a technical analysis point of view, we don't have anything there, right? There's no wedge, there's no, you could possibly argue that there's a flag. In which case, if we do argue for this being a flag, then we could project with the pole, but that puts us, down into levels that we haven't seen in like 2 years, and we're on a weekly. We need something a little more relevant than that anyways. We still have a gap to close at 1774, which, we've gapped through. So the gap now still is there, but it's overhead now. And there's another one at 1639. We're floating in the middle of nowhere this morning, somewhere right around in here. So downside drift, it's going to be 16.5, maybe an overshoot to 16. And then we're going to be looking for this to find some stability. Just keep in mind with a double bottom, what IBD always talks about, a good double bottom is supposed to lure in the suckers and trap them, right? So if this is our really big double bottom, and we would want to look at it, on a higher time frame, like a weekly, then this would be the overshoot that drew everybody in, and then the rip to the upside, which kind of failed. The downside measured move from the head and shoulders up here is done. So we're done with that. Yes, that was a head and shoulders, and yes, it's already been accomplished. It's over. Even the argument for the double bottom doesn't fit when you come out to the weekly, because it should have rolled over, come down, made the double bottom, did whatever it was going to do, and move on. And instead, we've got this trash. We're looking at an air pocket of risk. I mean, there's nothing down there, even for levels of support or some structure. Could see a flash crash in natural gas. All right, bonds continuing to roll over. They've been doing really good compared to everything else. This kind of ties in a little bit with capitulation that we're seeing, yesterday and today, basically across the board selling in everything. That's not likely to stick. If we're going to continue to see a rotation, then we're going to see the money rotate out of one area and go into another area. Someone way smarter than me has pointed out that when we don't get capital rotation, when we don't actually see that rotation, and instead we get both sides going up or both sides going down, it leads to volatility. So we're either going to get the rotation we're looking for, or we're going to get some serious violence in the market. One or the other. So you want to continue to keep your eye on the VIX, since it's, it's the only thing we got. There was a great video that came out on stockcharts.com last week that talked about the $34 level and the $20 level, and then made the comparison to the idea that every time we got below $20 and began the rally back up, the S&P was topping out and began rolling down, falling down. And then when the VIX was topping out into $34, that it was the S&P was bottoming out and was making a move back up off of those lows. Well, we're a long ways from $34. We haven't even begun to pick up anything here. Over the weekend, I was doing a write-up, as I usually do on the weekends, and I pointed out that correlation yet again from that stock charts video. The VIX on the top, the S&P on the bottom. So the VIX got up into the $34 area around, early to mid-October, while the S&P was bottoming out around early, late September, early October. Same thing, VIX around 20 at the height of that August rally. So we're coming up off of those lows, although, a little faulty, like it was back here where it began to rally up off the lows and then couldn't hold it and retested the 20. Seems like we got a little bit of that going on. But then it really picked up, right? We had a little bit of a false start, retest on a Busby, and then within 4 days, it reached the top of that $34 zone. And in that same period of time, we had FOMC in March. That's where Apple went nuts and just ran to the upside. The whole market got dragged kicking and screaming up, rolled over at the 1st of April, and down we went. So this is still pointing to the idea that we're going to see a rise in the VIX back up towards that $34 area and a fall in the S&P with continued lower lows and lower highs, right? These are the same swing lows, swing highs that we were looking at with the Linreg line across the chart. We're looking for the next leg down. So what would negate all of this? If we start to see a little bit of a move to the upside today, it doesn't mean that all of this is not going to happen. As long as the VIX continues to maintain above $20, we're going to continue to anticipate that this is going to follow through, right? So we would want to see the VIX dump back down, maybe cross below 20. That'd be a good start. All right, we still got 121 on Apple. Needs to get through this June low. around 129. Tesla had a nice little rally up yesterday for a good retest and a good place to join in if you had already closed your short and was looking for another one. Still looking at 125 for the next Tesla target. We have a minor pivot at $81 on Amazon. It's really minor, not a lot to it. And then below that, around 75. NVIDIA and the rest of the chips weren't really looking all that good this morning. We're very likely going to complete that move back down to the 155 area. Basically getting a reset from earnings. So 156 is kind of on the table. See if we'll get a little bit of overshoot. Meta was on the list for contrarian names of 2023. Basically an argument that says, well, we're going to expect the rest of the market to, for the most part, continue to drift lower. And yet a long play in Meta, for whatever reason the article had, would be a contrarian play that they're already starting to see bids on. So Tesla was another name on that list, by the way. So it was a Seeking Alpha article that came out over the weekend. Top 2023 contrarian plays. So it's not the idea that they think that it's a good idea to go long in Meta. That's really not their argument. It's if you want to go against the grain, if you want to go against the flow in the system and against what everybody else believes, take the other side of the trade, go long Meta. Looking at it on the weekly, if I had my moving averages on there, there's an argument to be made that if we get above the weekly 20, it would be the first time basically all year, right? And it would start to demonstrate that rollover from, kind of Dow theory logic. from accumulation into distribution back to accumulation again. We'd want to see this kind of start building a basing pattern along these lows and then eventually begin to work its way back up. 2023 might be a little early on that, right? Considering we haven't had even a test of it yet, let alone a crossover on that 20. I still think it's a little early, but we're starting to see a little bit of energy names coming back. There's always the argument about, do you want to be early or do you want to be late? So the bear flag is pretty obvious on a lot of these names. Bear flag or a bear pennant. Now I have a trade that I really like called a bear flag failure. It's a really nice setup. Really bases the idea along this wedge, whether it's a bear pennant or just a regular bear flag. But it would be the idea that you get price in a compression at the end of a long pole, and you're looking for an IX10 or just a break out of the wedge with an upside reciprocation back to where you came from. So on EOG here, it'd be back up to the 140 area. It ends up forming a really big cup by the time you're done, right? And then you'd look for the handle on the cup, and everything just continues to rotate and cycle through. The idea would be, if it's going to do that, then we're going to need that breakout. And since, ConocoPhillips and Marathon Oil and Valero all kind of have this really nice bear flag, bear pennant, that we would expect to see that kind of breakover begin in all three of these names, not just in one of these names, right? With MPC leading the way, it looks like. It's a little early. No reason to jump the gun and try to run it to the upside yet. It would be even better risk reward wise if we could get another test of the lows first and then a run up. Either way, after having this move to the downside and building this base, it's a really good base in energy, we're primed for a new directive on the energy side of things. All right, 19% of the S&P is down at least 0.5% this morning. %23 of the NASDAQ is down 0.5% this morning. Not as many China names in there as I would have expected, but two of the big ones that always matter, JD and Baidu, PDD. All right, we got the S&P 500, and we really want the S&P 100. So we just get it as close as we can to 100 names. We got a lot of gray here because it won't respond with color until it's moved at least 0.5%. Since that's my benchmark, it's usually where I like to start anyways. Stands out really nice with the monsters of tech because they are the bigger boxes. Tesla, Google, Meta, Microsoft, Apple. So we see a little bit out of Walmart and Goldman Sachs. Both of those are on the short list. So let's go take a look at Walmart. It's got a really wide bid-ask spread from 142.08 to 143.80. Okay, it's a little wide. So that puts us right underneath this 50. We're going to be looking to see, are we going to base down here and finally manage to get a crossover, in which case we're going to aim for that 147 area. Or we're going to reject here, retest the lows at the 142, and then get a measured move down to the next zone at around 137. You see the 200-day moving averages between 137.70 and 138.80, right around in there. Nice little area. It would be a break of this pivot point back here from its earnings. So like an earnings reset. Give us a clear double bottom. So the low is well defined, or the downside target is clearly defined. Something to think about. If you've seen my video where I laid out levels and I talked about going to something like a monthly chart and snapping your line where you have a lot of open, high, low, close all in the same spot, that becomes a pretty significant level. And Walmart is there. Now we're still inside candle on the month. So, technically we haven't gone anywhere. But we're testing that August high. This may overshoot a little bit, find some support, and actually hold here. So that short on Walmart might want to approach with a little bit of caution. So one way to do this would be a break on the week if you are looking for a good swing trade. How we finish this week will become very important because we're going to be focusing on, a basing pattern after this rollover that we either base here and we begin to move back up, or that we fail here and break through and continue that move to the downside. So Walmart is setting up for a really good trade here. If it begins to move back up, it should be a fairly quick process into, the end of January for that move back up into 50, 52, 54. A breakdown, yeah, should get us below that 140 quickly. So I would say use the current week's low, this 142. If we get a break on that for the week and begin moving below it, that would be a great short opportunity. If you're looking to catch it on the high for a flip, well, we're getting a little bit of a bid today. So you could look to see a rally up into yesterday's open, or I should say Friday's open. So, today will open, get a little move up, see if we hit that resistance at 144.5. Yeah, Monday's high, and then you got Friday's open. And it kind of ties in with the 200 period moving average on the lower time frames, or the 50 period on the hourly. And we would just be looking for that continuation, right? We're at a critical level in Microsoft. If you're looking for a new short here, down to 220, 221. A break below 238 begins the new short. If you're not already in it, I'm already in it. I'm not looking to, yeah, I'm already in. But if you're looking to get in, a break below 238 would trigger a new short play. Really don't want to see it get back above 242. All right. We've been making the argument for a bearish case, but be careful on Apple here. We've got a classic perfect double bottom, and it just screams a trap. So, kind of game this out a little bit. Here's your low. Here's your rollover, your double bottom, and it's supposed to It's supposed to go lower than the previous low, right? So it's exactly that. And it goes just low enough to get everybody convinced. They all start piling in to run this thing short, traps them, squeezes them, and you get that explosive move to the upside. Now, I'm short Apple, so I'm definitely not making an argument that, it's got to go up. I am just pointing out, be careful on this one because it is primed for a really beautiful trap, just like it did back here. It actually had a matching low, which probably was a little bit of a hint that it wasn't going to break through and continue to go lower. But a matching low with a strong rally back up to close high off of that low, ended up coming down to retest again, but still that double bottom held. Still got 125 for the short side target on Apple, and then 121, basically coming down to that 200 week. But it's been a heck of a fight because, this is like the darling of Wall Street. So everything is going to depend on how the market evaluates what's going on with Euro, with Japan, with China. It's all FX today. So, like it or not, really keep a close eye on the bonds, watch the FX markets, and keep your eye on finance juice. They did a really good job last night pointing out what was happening in US dollar Japan. And watching the dollar did absolutely no good because when that move kicked off last night, the dollar went down, the S&P went down. So it wouldn't be much of a heads up. The VIX will be more useful today than the dollar. That's my argument anyways. At least that's what we're seeing at this point. Yeah. Okay. Yeah, that is a head and shoulders, but it's in the middle of nowhere. So you don't really want to count it. All right. For crude, you got that 200 period daily moving average overhead, a rally into the 20, just like we rallied into the 20 there and all through here. So, if you're looking for a new swing in crude, you got to at least get above and close above that 20. Then we can target, 80 and target that $50 or that 50-point moving average. But we got to get above the 20 first. We are forming a bit of a wedge down here. Don't expect that it's going to be able to hold this for much longer without finally making a break. On the weekly, you can see how the 200 period kind of helped mark that low. And $80 lines up really close with the 10-week moving average, which would be our next test anyways for a run back up. Kind of like the old saying goes, doesn't really matter where you go, you just can't stay here. All right, so you should be good to go. We got our levels. We got things to watch for. With the China names down and the emerging markets down, and we're seeing, JD and PDD. If we were to see a short covering rally today, it very likely isn't going to show up on, your market breadth. You're going to want to focus on K-Web and emerging markets first to start to identify that move. And then you can run a Discord search for names that kind of fit the bill in that short interest squeeze. It's the same names that's been there, so probably not going to see anything new on that list. I know ARC is on there. It's been on there forever. BBBY, Nokia, is same names, right? It doesn't change. But if we're looking for a short covering rally today, that's where it would come from. You could also see it in names like Tesla, considering how far it's fallen, right? We're just looking for, if we were going to see a move to the upside, where would that come from? From shorts covering, right? So names that have fallen really far, when we're starting to make that argument, well, we fell a long ways, isn't it time to bounce at this point? Dead cat bounce, maybe a little run to the upside. You want to approach it from two different directions. Names that's been on the short covering list, because they're just heavily shorted names, but then also names that have recently just made really big moves to the downside, like Tesla. I don't think you're going to see it in your advanced decline lines. Yeah, definitely Tesla. Tesla's fallen a long ways, right? So if we were to make the argument of a short covering rally in some of the bigger names, right? Microsoft, Apple, Amazon, you would have to put Tesla on that list for a rebound rally. That's the only thing that we have on the table for any kind of argument for a move to the upside today, is a short covering rally. There's certainly no economic data on the table that could cause us to believe we're going to get a rally. So that would be what I'd look for if we did start to rally. You got to start asking the question, if you see the S&P beginning to move up, what's lifting the boats? And a short covering rally is the only thing on the agenda that I could see that could possibly do it today. All right, everybody, be careful, be safe, have a good day. I'll see you all tomorrow.